and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in. And if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi and welcome to another edition of the Capital Mind podcast. This one is going to be interesting. Last time we talked about houses. This time we're going to talk about another element that's doing the rounds because people are buying mutual funds. And then, there's so many things too that we've heard from people that the most basic question that we want to answer right now is, how do you buy a mutual fund? I mean, just as simple as that. Aditya has got a bunch of questions for me. And I'm going to try to tell you in my own little way about how I think of the mutual fund buying process, and perhaps as a person who might be entering into this field yourself, a person who's experienced, you might find some valuable insights from this. Again, welcome to the Capital Mind podcast, and hi Aditya.
Hi Deepak, it's amazing to be here, especially after the housing podcast. So I just want to start with a very simple question. Deepak, why is life so complicated? Why is it so difficult to buy a mutual fund? Like, there are 40 mutual fund companies. Each has a lot of funds. Each fund has a dividend and growth option. And each option has a direct and regular plan. So why is life so complicated?
That's a brilliant question. In fact, I think a lot of these plans, options, direct, all this stuff is actually a consequence of the industry kind of tripping on its own shoelaces, right? So because you started off with something, you said, there are so many stocks, how will we select between all those stocks? There are so many other things, how will we select? So let's make a mutual fund. Some fund manager is a smart enough guy, he'll go and figure out which stock to buy. Maybe he'll buy 10 stocks, maybe he'll buy 100 stocks. I'll listen to his philosophy, I will go and invest my money with him, and we're done. But now there are 400 mutual fund managers, and you're like, okay, everyone has a philosophy. I don't have the time. Kiske paas time hai yaar? Go through 400 philosophies, and then after I understand some philosophy, he will tell me dividend or growth, or dividend reinvestment, or bonus. There are 4 options actually, and nobody knows about them because everybody's like, acha, what do I do? Okay. Then if I choose that, okay, I've understood. This is that, there's an ad about this, or I think this is part of a movie where this person goes to this counter and says, I want a cup of coffee, and he says black or with cream. So he says, okay, black. Okay, but do you want low foam or something else? and then do you want sugar? Do you want this? Do you want hazelnuts? So by the time it's like, I just want a cup of coffee. Just get me a cup of coffee. So it's like, get me a mutual fund, or whatever you guys want. So it's complicated because the industry makes it so, because there is some fringe element who says, I want a mutual fund that I want dividend every month, not every quarter. And therefore, I want an option that tells me there's a monthly dividend option. And I want a regular or a direct plan because regular plans involve paying somebody commission. Let me simplify all of this for you, okay? Simply forget about dividend options.
Okay.
Simply forget about regular or growth. Is if you're listening to this mutual fund, you want to buy a mutual fund. So you're going to go to the direct option. That's it. If you want to go to the regular option, don't listen to this podcast. Go find an advisor. He will buy you a regular mutual fund. He will explain all these things to you. That's his job, and he gets paid for this process. We will explain now only direct growth options of mutual funds. Regular growth, once you've got that, and then you got to figure out now between, I want large cap, mid cap, small cap, this cap, that cap, and all that stuff. And that is just the equity portion. There's a whole lot of things around the debt portion of a mutual fund. The debt component of a mutual fund is simply, or the debt component of mutual funds is simply this. A mutual fund isn't supposed to invest only in equity. Mutual Funds Sahi Hai doesn't mean equity mutual fund sahi hai. It just means that you're going to use a vehicle to invest in something. You could actually pool in money if it was possible to invest in a house. If it was possible. It's not possible right now because there's no easy vehicle to do so. But mutual funds can invest in stocks. They can invest in bonds. Bonds are like fixed deposits. Stocks are like, stocks. They are risky. Both have a different level of risk. You choose the mutual fund as a vehicle to invest in whatever you want to invest in because you don't have the expertise in investing in those things yourself. Now, what we'll go through is perhaps a concept of saying, these mutual funds are the 4,000 whatever mutual funds, different mutual funds. If you take all the options, direct, dividend, ye, wo together.
So despite this being so complicated, say I want to invest in a particular mutual fund. Help me find one. I even don't know what should be my allocation, equity, debt, 50-50 or 60-40.
Yeah, so I think the point comes is, don't go trying to buy a mutual fund. Okay, you've got some money, you've got some savings, you've got some investments which you've already done.
Okay.
Put that together somewhere and say, yeah, this is where I am right now. I have money in the bank. I have a PF. PF is basically like debt. It's not going to be risky for you. It's going to be invested in something relatively safe. So you consider that like a debt investment, which is a separate allocation. And then you say, okay, totally I have say 5 lakh rupees, 1 lakh rupee or 10,000 rupees. It doesn't matter what you have, but you have to figure out what you have in the first place. Now, when you have that, you say, okay, going forward, I am comfortable with how much risk. Now, if you meet a financial advisor, you might actually nail down your goals, long-term, retirement, kids' education, and all that stuff, which will be a more detailed thing. We do this at Capital Mind Wealth. But let's assume you have nothing. You have like, okay, listen, I don't want all that. I just want something, Okay, let me tell you this. First, find where you can take risk. I am saying if you have 10 lakh rupees, don't go around investing 5,000 rupees in an equity fund because mutual fund sahi hai. Because 5,000 rupees is going to do nothing to your life.
Exactly.
You need to figure out how much of my total amount I have, should I have in equity and should I have in debt. You're thinking long term, you're thinking at least 10 years, 15 years from now. And you're saying, yeah, okay, I'm the long term, I would rather be risk averse. Risk averse, in the sense, totally risk averse would be 0% equity. Don't do equity at all. Just do debt. You can do debt through fixed deposits, very tax inefficient. You can do debt through debt mutual funds, better, but has a small amount of risk. If you're really, really risk averse, just go buy liquid funds, those large liquid funds. Like currently it's HDFC and ICICI. It may be something else tomorrow, but it's basically those extremely large liquid funds. They will give you a nice return, possibly better than a fixed deposit in the long term. I have personally got more than 8% returns in the last 5 years in liquid funds, but your mileage will not be the same. You will not get the same kind of return because rates are lower now. But that's the safest. Just buy it and keep it and don't worry about it. Now, if you're saying, okay, I want to take a little bit of risk, you can say, okay, out of my 10 lakh rupees, I want 2 lakh rupees to sit in equity and 8 lakh rupees to sit in debt. This can be 10,000 also. It doesn't matter. But I'm okay with only 20% equity. Now, what do I mean by 20% equity? It means, if my equity falls by half also, if out of 100 rupees I put 20 rupees in equity, I will lose 10 rupees, right?
True.
But in that remaining 80 rupees, I will make some money out of debt. So 1 or 2 years, I will recover that 10 rupees. So essentially in 2 years, I will go back to being where I was, which is actually not too bad because I won't lose any capital in 2 years. So it's roughly safe to say that I'm okay. Within 2 years, I will recover my money. So even if the market fell by half, in all probability, market may go up. So it'll give me a little bit of an upside, but it won't give me a huge upside. So 100 will become 110 in a year, maybe 111, but not 140, 150. So I trade off the risk versus the reward, and I say, okay, I don't want to lose too much, so I will not take too much risk. So 20% equity, 80%. That's fine. Once you've decided that, that's great. You can say, okay, I want to decide what my equity allocation should be. So my equity allocation should be 70%. And if I'm saving 20,000 rupees a month, then I should put 14,000 rupees in debt and 14,000 rupees in equity and 6,000 rupees in debt. That's my rough thing, So find out where you need to be and how much debt you. Now people will say, how do I decide between 65 and 70? You know what? There's no such thing. You say, okay, either I'm 20% equity or I'm 80% equity.
Okay.
Just about that. Anything in the middle is a trade-off. And if you can't decide, just choose 50-50. Put 50% in stocks, 50% in bonds. Why do I say that? Now, in the last 10 years, an SIP in a liquid fund has given exactly as much as an SIP in the Nifty itself. And many mutual funds.
Amazing.
So, effectively, debt is not worse than equity. Debt can be better than equity, and equity can be better than debt. If you don't know what to do, just put half and half in both and you're done. So it's not rocket science to put it in both. There are periods of at least 10-15 years where even SIPs in mutual funds have returned less than the equivalent investment in a bond market. So, which means in debt funds. So there is no hard and fast rule saying you have to be in equity, but so you choose. Now you say, well, now I know how much money to put into equity funds. Part of that can be a amount I've already saved, which is currently sitting with me as cash. And I say, okay, listen, I've already got so much money in an FD, that is debt, some money in PPF, some money in PF, some money in some LIC policy. All these constitute some layer of debt. But I want to now put a certain amount lump sum into equity. And then every month I want to put some more money into equity and some more money into debt. So it's like a choice I make as a planning level. Now, once I planned, the next stage is where I think people are going to need a lot more help. Is once I've decided how much money I want to put into an equity fund, now what do I do?
True. So suppose, as you said, I do 50-50. But when we talk about equity mutual funds, again, there are a lot of complications. Like for an investor who wants to invest in equity mutual funds, how should one decide the allocation between large caps, mid caps, small caps, and multi caps? Now, recently, as you know, SEBI has classified mid caps as the highest market cap companies from 100 to 250. So basically, the mid cap companies have drastically reduced to just 150 odd companies. So if I'm not wrong, isn't this category gonna lose their best performers over time? So all these complications may confuse retail investors. So how should one decide the allocation?
This is where I think life has gotten complicated from a SEBI angle and also from the mutual fund themselves, because they call their fund large cap. Sometimes they have to, because it's the way the fund is. But here's the thing, okay? The concept of a cap is simply the size of the company if you sold all its shares.
True.
Amazon is a $1 trillion company. So if you sold all the shares of Amazon, you would get a $1 trillion. This is a hope in hell, really, because if you actually try to sell all the shares of Amazon, you wouldn't even get $100 billion, not even 10 billion, because if you're selling all the shares, who's going to buy?
Who's going to buy?
It may not be, a useful company to sell. But the point over here is that if you sold all the shares of the company, what is the value of that company? It's almost like you valuing your house. If I value my house because my neighbor bought his house at 100, but I know that if I go to the market and try to sell, I might get a much different, lower, higher, some different rate, but you use his value as a benchmark. So every day when shares are bought and sold, the buying price or the last traded price of that stock is considered to be the value of that stock. And therefore, total number of shares that the company has into that share price is equal to how much you can get. Reliance today can get 800,000 crores if it is sold. TCS can get something around that. HDFC, AMC can get only 75,000 crores. I say only, but it's still a large number. And then you've got the much smaller numbers behind them. So you've got a BPCL at 50,000. You've got a Manappuram at 18,000. Equitas Small Finance Bank at 3,000. And so on. So now you classify these into market caps. So you say, take the top 100 companies, and top 100 companies in India end at around 30,000 crores in market cap. That means the top company is 800,000 crores, the 100th company is about 30,000 crores. You say, I'll only invest in those. Now, of those, if you want to invest only in large cap companies, that means companies whose value is in the top 100 companies in India, you're going to choose a large cap mutual fund, where SEBI has said now, this is as of last year, that you can only invest in companies which have which are in the top 100, or rather, out of your 100 rupees if you have in the mutual fund, 80 rupees has to go into these companies.
Okay.
20 can go outside. So people typically keep a little bit of cash. They'll have some investments where, I've invested in BPCL last year, but now it has fallen to just below 30,000 crores. So should I sell it? Not. So there's a little bit of leeway that says if it just falls off the radar, maybe you can continue to hold it. So it's only 80%. That means that most of these mutual funds or these mutual funds are restricted in what they can buy. So they can't really decide that I'll go and bet a lot of money on a smaller company, because if they do, then they will violate the guidelines. So all of these large cap mutual funds are going to go and invest in the same 100 companies with 80% of their capital. So this is one part. That's to understand. Now, mid cap is, listen, I saw the top 100, but you know what? The best companies are perhaps smaller when they started. I want to be there when they start. So I will invest in a mid-cap mutual fund which says companies number 101 to 250. These typically right now are about between 30,000 and 7,000 crores. So 7,000 crores is the lowest end, 30,000 crores is the highest end. That's roughly the market cap range you're talking about. So more than $1 billion and less than maybe $4.5 billion. So that's the kind of market cap we call mid-cap. There are a lot of companies here where the growth may be spectacular because they're relatively small and they have a big runway to grow, but they also could be companies that were earlier large caps have become mid caps. So you're going to get the worst of the large caps that come down to you. So the handouts from the large caps will come to you. Second, you will also get fast growing companies like a Bajaj Finance, which was a mid cap at some point. It grew so fast that it became a large cap. When it becomes a large cap, a mid-cap mutual fund has to perhaps reconsider whether it can hold it or not. Now, large cap funds are required to put 80 rupees out of every 100 into large caps. Mid-cap funds, the limit is 65 rupees out of every 100, which means 35% of their assets can be held in other companies. So they get a little bit more leeway. So a mid-cap fund may be quite an interesting thing. To complicate matters, there are large and mid-cap funds. There are multi-cap funds. There are small-cap funds. There are sectoral funds. There are strategic and quantitative funds. So don't ask why all these things exist, but they exist. And so don't confuse yourself in all of those. Simply, I would say this. For a beginner investor, if you're starting off, just stick with large cap funds. If you feel that you're slightly more smart than a large cap guy, go to a 60% large cap, 40% multi-cap. Multi-cap means the fund manager gets to decide whether he wants to put money in large cap or small cap or mid cap, depending on his choice. This is great because that's what you're doing. You're trusting the fund manager with his choice of funds. Now, he therefore gets the flexibility. You get the potentially higher return if he's smart. So you could then therefore adjust the risk. Now, if you're going to be smart enough to say, listen, no, I want 20% mid cap, 3% small cap, 4% cap, then become a fund manager and go and buy all these stocks yourself. Why are you bothering giving money to mutual funds? It's not. Keep it as simple as possible, as less funds as possible. One large cap fund, maximum 2. And one mid-cap fund, or at the max 2. So just keep it as simple as possible. And I think you will find that today, for instance, there's been a good performance by, say, an Axis or a PPFAS, which give you a broad multi-cap exposure. When I'm talking about multi-cap funds, both of them have a multi-cap fund. Luckily, they can have only one multi-cap fund. So multi-cap funds, being that since you can get large exposure, you want a fund that has at least 50 to 100 stocks, some large, some mid, some small, some kind of background of the philosophy of the company. And PPFAS, for instance, which is a mutual fund that is relatively small, has investments in non-India as well. So they buy Google and I think Google and Facebook or some non-India stocks, some FANG stocks. So there is that flexibility also that they can use. So you might want to bet on that as a thing. If you don't understand any of this, forget it. Just choose a large cap fund and stick with it. And we will talk about large cap. So I think the best way to do large caps is simply buy an index fund that buys the top 100 Indian companies. That's all.
Okay.
The definition is it has a top Indian companies at all times in the proportion of the Nifty. So Nifty is top 50. There's something called the Next 50, which is the Nifty Next 50. So either you can buy an index fund called the Nifty 100 index fund, or just buy a Nifty 50 index fund and a Nifty Next 50 index fund. Both of them, don't make a choice on what companies they can invest in. The choice is made by whoever creates the Nifty 50.
Okay.
The Nifty 50 creators also don't choose. They have a specific set of rules. Highest guy is number 1. Next highest guy is number 2. Next third highest guy is number 3. So they just put this, and every 6 months they say, oh, this 49 fellow has become 53. Then make the guy who's become the new 49 as part of the index, and the other one has gone out of the index. So automatically the index fund will sell one and buy the other, and life is good. This simple combination has been some of the best performing mutual funds in the last 5 years. And in the West, in the last 20 to 30 years, they have shown consistently that they can beat most mutual funds. Not saying that the mutual funds don't have an edge. Some do, obviously, some will be on top. But I'm saying 1 year, one guy is on top. Another year, the same guy is not on top. He's probably somewhere in the middle. And third year, he may be in the bottom. And the fourth year, he may come back on top. Don't want to deal with all these complications. You just want to deal with, say, I don't want the exact top mutual fund, but I want someone in the top 25%. Give me that. Large cap, go for indexes. They are so much simpler. Don't need to choose. Very cheap. Nobody will sell them to you. That's why I tell you to buy them. Because if you're making those decisions, choose what's right for you, not what's right for your distributor.
Since you have talked about index funds, I also want to talk about expense ratio.
So interestingly, the expense ratio is available on many sites, both on the, so now there's so many funds. How do you find all this information? Where's the expense ratio? ValueResearchOnline.com, search for a fund, you'll find its expense ratio. Typically, there'll be 1%, 0.5%. So the higher the expense ratio, typically the worse the fund should perform. But many funds in the past have done very well despite having high expense ratios because they have superior stock picking or some ability to earn more money. What you really care about is the consistency of its return profile over time.
Okay.
If the fund manager charges you a lot, doesn't matter. If he's consistently in the top quartile. So if there are 30 funds in large cap, and out of those 30 funds, my fund is within the top 5 or 6 in a 1 year period, in a 3 year period, in a 7 year period, in a 9 year. All you care about is that. So 1 year is not even relevant. Don't even bother with 1 year returns. Okay. So 1 year is such a lousy number to look at. Nobody should care. Start with 3 years, 3, 4, 5, 7, 10. If a fund is consistently in the top,
okay,
the 25%, I'm not even saying the top 1, 2, 3.
Just the top
if
quarter.
Its rank is up to 6 out of 30 or 7 out of 30. You should say, okay, boss, this is a decent performing fund, and that's how you kind of choose it. The expense ratio is already accounted for in the return, so you shouldn't care. Now, the reason there's a difference in the two is because if you choose regular funds, you will literally pay twice in most cases the expense ratio,
okay,
and therefore the return profile will be much lower. Now, people do not compare regular versus direct a lot. But the same fund which invests in the same stocks in the same proportion can have a lower return if it's a regular fund, a higher return if it's a non-regular fund. If you're thinking of regular funds, then you should go meet a distributor who will help you understand all of this in much more detail on a one-to-one basis. And therefore, you'll be able to justify that you're paying more. Somebody spending the time explaining all of this to you and on a one-on-one basis, which even I will not do because it'll take time and I cannot charge you if I do this in a direct mode. But because we know a lot of people are listening to this, I think the idea is justified. But if I do direct, that means I'm taking the responsibility, and therefore I don't have to pay someone commissions. So I want a higher return. Instead of giving commissions away, give me those commissions effectively as returns in the fund. That's what you're saying. There the expense ratio matters. So I want a direct mutual fund to cost less than the regular mutual fund. It will almost always happen.
True.
And I also don't want the expense ratio to be skewed in the favor of the fund manager, that it affects the returns. So if the returns are bad and the expense ratio is high, then I think before even looking at the expense ratio, you would walk away from that fund saying the returns are not good enough. So where you evaluate things is just use returns and risk over a period of time, but don't look at expense ratios.
So another question that I wanted to ask is, should one deploy the funds all at once or should one sip? This actually reminds me of an incident that happened with me. So a friend of mine was calling me like a month or 45 days ago when the markets were falling. So he every day he used to text me on WhatsApp that should I deploy the lump sum now? The markets have bottomed out. Do you think the markets have bottomed out? I just want to deploy the lump sum. So people actually try to time the market.
In general, timing a market is a skill, which
Okay.
means you should have enough knowledge about the markets to say there is a point where I don't want to get in. If you possess that knowledge, use it. Don't stop yourself. After you do it once or twice and find out that you are good at it, then you can continue to do it. Put all your money in when you think the market is weak. Is going to rise. Take all the money out when the market's going to fall. There are some problems and I'll explain those. When you buy a mutual fund, you just think, okay, and buy it. But you can't sell it whenever you like. Some funds are locked in.
True.
Some funds have an exit load. They will charge you 1% just to get out if you get out within a year of purchase. So you don't have to get out and get in just ignoring all of this. You should know that getting out cost me 1%, so I should get out. Some funds have no such exit loads. Some funds will add an exit load after you've gotten in. So that exit load doesn't apply to you. It applies to any further investments that you do or if somebody else does. But this is the way exit loads are designed. So an exit load will also tell you whether you should time or not, in the sense, because if the timing is only a 1% or 1.5% differential, why would you bother? Because you'll pay for the fund anyways. Now, the other point about this is about whether you can whether you're not good. Let's say you do this for 2-3 times and say, damn, I got in and then the market
Every
fell.
time I was wrong, suppose.
Or every time, or even 50% of the time, because you don't want to be wrong 50% of the time.
True.
Unless you're so good that you're putting so much money in that when you're right, you make 5x the amount that you lose when you're wrong. So if you're not good at it and you don't have the time, don't bother. The best way to calm yourself is to say that, listen, I'm investing on a 10-year period. Instead of putting a lump sum, I will invest, let's say, the same amount spread over 6 months rather than at one shot.
Okay.
Instead of saying I'll put 10 lakhs into the market today, I'll say I'll put 2 lakhs into the market today. I'll wait for a month, and in the next month I'll put another 2. And then another 2 in the last 2 months, maybe I'll put 1 lakh each. So it just spreads the investment around. And just to make you feel happier, if the market crashes in the middle, just put more money. So you will feel a lot better that way. Remember, a lot about investing is behavioral. It has nothing to do with whether returns are better or not. We confuse ourselves in that conundrum, okay? And I think you rightly put it, and we've eliminated that question. But really, many people with a 24% return can actually end up with a much lower number, actual absolute amount, than another person with a 8% return. Why? Because the guy who invested 8% put 5 lakhs. The guy who invested 24% played around with 50,000 rupees.
True.
So he got 24%, but he ended up only with, because although he may have had the surplus, he just put that surplus into or spent it instead of investing it. And then he's left with a lot lesser, simply because the person who invested, say, 2 lakhs or 1 lakh or just 1% more investment is much greater than 1% more return. That means if I was investing 20,000 rupees a month, if I just invested 20,200 or 20,500 rupees, I will actually make more money in the long term than getting a 1% more on the investment return over a long period of time. Simply because of the way this stuff compounds, it will kind of add up. It's like you are giving yourself a 1% more return by just adding 200 rupees more to a 20,000 rupee monthly saving, rather than by trying to get that 1% more by selecting multi-cap, mid-cap, large cap, mid-small. And you can go mad like that. Yeah, give yourself, the differential is 1%, 2%. I'll put 1%, 2% more. I'll just select an index fund and be done with it. So it's much easier to think of it that way.
I know a lot of people invest in mutual funds solely because they want to get the tax benefits. So they invest in ELSs. But I see a lot of people investing in 3-4 ELSS funds, which I believe defeats the purpose, because then a lot of stocks may overlap. So do you believe it's a good strategy to over diversify in ELSS funds, say owning 4 ELSS funds?
I think owning 4 funds of the same type of any type of mutual fund is a waste of time. You will, if you buy 4 large cap funds put together, you own the index.
True,
so you're paying
a
higher management fee to own the index. What's the point? ELSS funds are supposed to be tax saving. Now, do you even need ELSS funds? If you have a PF of 10,000 rupees more, or maybe 12,000 rupees or more, you don't need an ELSS fund. Your PF at your workplace covers the tax benefits that are given to you. Second, if you have a child who's going to school and you're paying school fees, those school fees are exempt under the same amount applicable for tax as ELSS funds.
Okay.
So if you have a kid going to school, don't pay ELSS, don't buy an ELSS fund. If you've got PPF, and you're investing in PPF every year, don't buy an ELSS fund. You can take 5-year bank deposits and then also don't take ELSS funds, because now you're risk averse. ELSS is an equity fund, so don't buy ELSS fund. So insurance policies, again, you may need term insurance. You may be paying a certain amount, say 40,000 rupees a year. You only need the remaining 1,10,000 to be invested in an ELSS fund, so you could use that. Now, you don't need to invest money in an ELSS fund just because somebody tells you it's tax saving. The tax saving may not apply to you. You may already have had that tax saving, and therefore don't listen. Now, within the ELSS fund, you want to choose one fund. You want to put money into it 3 years, one year after the other. If the ELSS rules continue to apply, after 3 years, your fund becomes free, as in it opens up after the 3rd year. So in the end of the 3rd year. So in the 4th year, the first year's investment becomes available to you. Redeem it and put it back. So at any point, you will not try and put more money into an ELSS fund. You just keep reinvesting the same amount of money. There is a reason for this, not because of anything else, or not because I just feel that there's no need to lock in your money. Any other avenue, the same fund house, a different fund, may actually give you much better returns and give you liquidity. So you'll be able to add more whenever you want. You'll be able to take out money whenever you want. That flexibility is not available with an ELSS fund. So I would say keep the money, keep it relatively less, invested. So you can do 3 this thing, and having 4 or 5 funds is a waste.
No, actually, this reminds me of, I met someone, and so there's a lot of enthu right now. People are entering the mutual fund industry and people are doing SIP. So I met someone and I asked him, like, how many mutual funds do you own? So he said 4. And then he said all are ELSS. So I said, why? So he said, because it's tax saving. So the more I invest in ELSS, the more tax I can save. So this is the kind of knowledge that people have. They don't know actually these things, and they believe that, okay, if I own 5 mutual funds, 5 ELSS कर देते हैं, उससे टैक्स ज़्यादा हमारा सेव होगा.
If that was the case, I would be recommending do 500. I mean, 5 से क्यों रोक रहे हो? I mean, 5,000 ही तो लगते हैं, आप 100 कर लो. Over 5 years, you can have 100. I mean,
this is a true story. This is not made up stuff.
But actually, in the end, the mutual fund is going to go buy the same stocks, whether it is this mutual fund or that mutual fund, which is ELSS, both of them. Most likely, they're going to buy the same funds. Go check the portfolios out. You might find a significant overlap. Each one will have HDFC Bank, which is there in every mutual fund. And then you'll have a bunch of others, and you see the overlap and you say, yaar, what is the difference? Why am I paying, why am I breaking my head over which fund to buy if they're all the same? If they're all the same, just buy one. It's not necessary that a fund like this will outperform every year. So choosing different funds, I understand that completely. So choose 3 different funds, at max 3. After the 3rd, then rotate the first one onto the better performing one in the list that you have. So at any time, you shouldn't have more than 3. And to be honest, you will never need it, because your life cycle will take you through children, take you through, by the way, a house principal, if you're taking a housing loan, even the house principal qualifies under the same bracket. So if you bought a house under a loan, in all probability, even that is contributing to the same tax thing. So you may buy only for 3 or 4 years and then stop. So just buy 1 or 2 funds at the max. Don't push yourself. All the ELSS funds have the same philosophy. So I don't think you should bother doing anything else with them other than this. And honestly, in any field, have 3 or 4 funds, not more than that. But because you're talking 2 large cap funds to multi cap funds. That's all you need.
That's
in the equity portion. When it comes to debt, we'll talk about debt in a different podcast, but debt is complicated. You have short-term, liquid, ultra short-term money market. It's like credit one risk. Sabji bazaar, credit risk, and bunch of others. You don't know which one to select. They're also very simple philosophy. Get something that is short-term, something that is longer-term, that meets your philosophy of risk. Don't push yourself into credit risk because somebody told you that it's a good thing, but simply say, okay, I want something that's safe. If you like that, just go to PSU and banking debt funds. They may be volatile in the short term, but over a 3 or 5 year period, they will actually do reasonably well. And there is some risk, of course, but at least you limited that to saying, "Acha, the government will not default on the PSUs, and so I will not lose my capital, and banks will not go bust, so I won't lose my capital." So I could live with that, and something that's more short term, so maybe liquid, ultra short term, where I can access the money whenever I like, and it still gives me a return that's better than a fixed deposit or a bank account when I'm not using it. So that is the way you do debt. We'll talk about debt in more detail at another time, but keep the number of funds you have small. So if you end up having more than 10 mutual funds, you're doing something really wrong.
Okay. So now here comes the funny part. So personally, I believe that looking at star ratings is the dumbest possible way of picking mutual funds, but actually a lot of people do that.
Yeah, the problem is the star ratings are given by human beings for the most part. The human beings sometimes don't look at the fact that these funds have defaulted, done badly. You'll find 5-star fund ratings in debt funds which have given you negative 10% return over the last 1 year. This is intolerable, but it's happening. And why is it happening? Because the people who gave the ratings are not accountable for the reason why the fund fell down. If I told you this is a great fund and I invested your money and I took a fee from you, I stand to lose my fees from you in subsequent years if that fund does really badly, because you'll say, "Deepak, take my money out and I'll move it away, and then you will no longer pay me any fees." Now this is a reason for me to try and perform. But if I'm giving a star and you're buying the fund on that star and you're not paying me anything, and I don't care whether you lose money or not, then what's the value of that star? It does nothing. It does nothing to please anybody. It just gives you a feeling that somebody has a star. It's like a star result in Google or many times on Amazon. The number of stars many times does not indicate the kind of quality.
True, very true. This is a very good example.
So because of that, if you're not going to trust them in food or in Amazon or in Google, then why would you trust them with your money? I mean, your money is more valuable.
So, okay, let's talk about sectoral funds. A few investors believe that if they can't take risks by investing in stocks directly, they can bet on sectoral mutual funds to bet on these underlying sectors. I believe this is a very dangerous idea, because on the contrary, I would say if you are really much into betting on sectors, why don't you go direct? Why don't you invest in the stocks rather than betting on sectoral mutual funds? Because I don't have control on the exits. Suppose I buy a sectoral mutual fund and I come to know that the story is not panning out the way I imagined, I may not be able to get out immediately. Rather, when I'm investing directly in, say, aviation companies, I invest in, say, SpiceJet or Indigo, and I suddenly want to move out, I can do that whenever I want. So what is your view on sectoral mutual funds?
So I think sectoral mutual funds are like, iPhone, when the Mac, Apple had this conference where it revealed that it has this fancy, fantastic monitor.
Okay.
Monitor was expensive, super expensive, I don't know, $10,000-$15,000, something like that. And then they said, this will do everything, you can do this, you can do that. And then they said, there's a stand. The stand of the monitor is like $1,000. Now, everybody's like, okay, why would you pay $1,000 for a stand? But this was Apple, and people got carried away by the hype and said, what, I want a stand worth $1,000.
I want that stand.
I want that stand. So sectoral funds are like that. It's like, what? I'm going to be smart. I'm better than the rest. I know when pharma is going to turn, so I'm going to buy a pharma fund now. It's fine. Everybody needs this mental stimulation at some point. So go with a 5 lakh portfolio, put 1,000 rupees in a sectoral fund. It's fine. Because even if you lose that 1,000, it's not going to change your life.
You get to learn.
So don't do 50,000. Don't do 10% of your portfolio in a sectoral fund. It's complete nonsense. Keep money that is about 0.1 to 0.5% of your portfolio for playing around and losing. Because every once in a while you'll feel this itch to go and play with some new fandangled toy, and don't hurt yourself in the process. Just keep a little bit of money and invest it, and then be very happy that 1,000 rupees became 2,000 rupees and how smart you were. But you can be rest assured that all your other equity funds are also buying pharma. So they would have also gone up because the fund went up. And if the multi-cap managers are smart, they would have had more of that allocation. The indexes will automatically give them a higher weightage when they start doing well. So those sectors will start coming more and more into index. So your index funds will also do well. So you will make money end to end, and you'll have something to write home about how well you chose your sectors. But don't get carried away, because if you're really good, like you said, just go by the underlying stocks and get out whenever you want. Get out of one instead of all five. Buy 5 or 6 stocks in the sector and just stick with it. So it's just the way it is. Simplicity is better. So
True.
keeping things simple is way better for you in your financial life than it is to try and complicate yourself with. Whenever you find complexity, find the simplest thing to invest in.
Okay.
So it's easier to invest in an index fund, and nobody's selling you that, because not only is it easy, but because it's less complex, people make less commissions out of it. So nobody wants to sell you this stuff. Buy the index fund. Buy the liquid fund, because nobody wants to sell you the liquid fund, because nobody makes commissions out of it. It's just the simplest thing to invest in, and it keeps your mind happy without having to take way too much risk.
So, quick question, Deepak. Where can we buy these mutual funds? Like which websites or?
Now there are hundreds. You can go to the websites of the mutual fund companies themselves and buy it. You may require a KYC. If you haven't got one, some of them will help you. There are other websites. There are websites like Paytm Money. There is websites like ET Money. There's websites like perhaps Grow, and there is Zerodha, and a bunch of others. There is also CAMS online. CAMS is one of the RTAs, and it allows you to buy relatively easily. So you can go to any of these funds and buy. Paytm or ET Money might actually have an easier interface to do KYC, and therefore get your investment in faster. But once you've done the KYC, you can buy at any of these places. And other than in Zerodha, where you have to buy in Zerodha and sell in Zerodha. But if you buy on one of these sites, you can actually go to the mutual fund's own website and then sell from the mutual fund's own website as well. So it's interoperable. So you can actually buy from one and sell from the mutual fund's own website directly, and they will not be a problem. So what is good about it is the regulations don't allow any of these intermediaries to take your money and keep them. And other than in Zerodha, where the money is again kept in a regulated account. So you don't actually transact with these players. You actually transact directly with the mutual fund houses. And that is how your funds are kept safe from people trying to ping this thing away. And remember, when you redeem those funds, when you sell the funds, you will get the money directly into your bank account. It won't go to any of these players. It won't go to Paytm Money. It will not go to. It will come straight to your bank account. So you will never have to worry about these portals going bust, not making money. Your funds are safe no matter where you invested from.
Okay. So I think we had an amazing discussion, and thanks a lot for answering my questions. And I hope our listeners liked the podcast.
Lovely. It's been great, Aditya. And thanks again. And all of you, thanks for listening. Please connect with us at capitalmind_in on Twitter. I am at Deepak Shenoy on Twitter, and Aditya is at Astute Aditya, ASTUTE Aditya on Twitter. And you can connect with us, tell us what you think, ask us your questions on mutual funds. Visit capitalmind.in. We have a bunch of articles there that are free, some are premium. So please consider subscribing to some of the premium articles as well. And we can help you on our Slack channels. We have a bonds and funds channel where we discuss funds all the time. And of course, we have Capital Mind Wealth as well, which is a portfolio management service where we will actually deploy your money into stocks and mutual funds, or only mutual funds if you choose that to be. And we can help you with the investing process as well. That's me advertising everything that we have. But have a great time. This is Children's Day here. I know you'll probably hear it a few days later, but just being a child, keeping it simple, and enjoying the rest of the day.
Thanks a lot, Deepak.